September 2008, a bank that had survived wars, depressions, and 158 years of history collapsed almost overnight. $600 billion disappeared. Retirement accounts evaporated. Millions lost their jobs. But the real trigger didn't start with complex math or evil geniuses in dark rooms. It started with a simple promise you could print on a billboard. Why pay rent when you could own Roll the Cheerful Music? It's the early 2000s. America is stumbling out of the dot-com crash. The shock of 9/11 is still rattling the economy, and Wall Street is nervous. So the Federal Reserve steps in with a solution: cut interest rates to the floor, practically zero. Money becomes cheap. Borrowing feels effortless. And suddenly, America's favorite hobby isn't baseball anymore. It's buying houses. You're approved for $500,000. But we make 40 grand a year. No worries. Adjustable rates, balloon payments, creative financing. Ever heard of a ninja loan? No income, no job, no assets. No problem. Back then, owning a home wasn't just about shelter. It was identity, stability, success. A slice of the American dream. And the message blasted through ads, billboards, and mortgage seminars was impossible to miss. Why rent when you can own? Banks were all in. Actually, they were more than all in. They were throwing money at anyone who could sign their name. Enter subprime mortgages, loans designed for people with shaky credit, unstable income, or a very loose understanding of how debt works. Bad credit, no credit, living paycheck to paycheck. Congratulations! You qualify for a luxury condo. Should I worry about paying this back? Not really. If you can't, we'll just sell the house for more later. It was a housing gold rush. A full-blown frenzy. Prices climbed non-stop. Your neighbor S house doubled in value in half a year. Totally normal. Baristas, retail workers, and part-timers with $5 in savings were suddenly homeowners. Lending rules optional. Down payments. Cute suggestion. If you had a pulse, you had a mortgage. Loans were pumped out like fast food. Brokers collected commissions faster than anyone could spell bubble. All of it was built on blind faith. Housing prices always go up. They always had, until they didn't. Under the granite countertops and open houses, one question quietly waited. What if this stops working? Spoiler, it did, and badly. By the mid-2000s, homes weren't about living anymore. They were about flipping. Buy today, sell tomorrow. Repeat. Real estate wasn't shelter. It was a lottery ticket. People owned houses they never planned to live in. Everyone was chasing the next buyer, willing to pay more. The more prices rose, the more people rushed in, like pouring gasoline on a fire and calling it growth. But underneath the hype, the foundation was routing. Those subprime loans were toxic. High risk, low documentation, barely verified income. And Wall Street had a brilliant solution. Bundle the bad loans together, slap on a shiny label, and sell them as safe investments. Mortgage-backed securities. How do you turn junk into gold? Easy. Get the ratings agencies to call it AAA. Here's the part no one advertised. The ratings agencies were paid by the banks they were rating. Everyone knew it. Analysts joked about it. Executives ignored it. Because as long as the machine kept printing money, nobody wanted to be the person who stopped it. Then Wall Street pushed further. They took those mortgage bundles and chopped them into even more complex products. Collateralized debt obligations, financial alchemy at its finest. Risk disguised as stability, and while most people bought the story, a few didn't. A small group read the fine print. They saw the rot, and instead of buying in, they asked the dangerous question. What if we bet against it? Wall Street laughed. Then they realized there was money to be made either way, so they built insurance contracts that paid if the system collapsed. Credit default swaps. You didn't even need to own the investment. You could bet on failure from the sidelines. The tower grew taller. Leverage stacked on leverage, fees flowed and bonuses exploded. And here's where the villain steps fully into the frame. While the risk piled up and the cracks spread, top executives kept cashing checks. 8-figure bonuses, private jets, champagne celebrations. The system was wobbling, but their pay kept rising. Heads, they win. Tails, someone else loses. Warnings came, whistleblowers spoke, regulators hesitated. Nobody slammed the brakes because slowing down meant smaller bonuses. And nobody on Wall Street wanted to be the adult in the room. At first, the collapse whispered, a missed payment here, an empty condo there. Then Rorad housing prices started falling. That wasn't supposed to happen. Subprime loans imploded. The securities built on them followed. Banks realized their safe assets were anything but. Panic spread. Hedge funds bled. Investment banks wrote off billions. Then came the moment that froze the world. Lehman Brothers collapsed. 158 years of history, no rescue. Just a $600 billion crater. If Lehman could fall, anyone could. Banks stopped trusting each other. Credit markets froze. It was like someone pulled the plug on the global economy. Businesses couldn't make payroll. Families couldn't get loans. Retirement accounts disintegrated. Jobs vanished. And while ordinary people watched their savings disappear, many of the executives who helped light the fire quietly walked away richer than ever. By late 2008, the system was in freefall. Foreclosures exploded. Unemployment lines stretched for blocks. This wasn't just Wall Street burning. It was Main Street too, and it didn't stay in America. Banks failed overseas. Markets crashed worldwide. The Great Recession had begun. The government faced a brutal choice. Let everything collapse or rescue the institutions that caused it. They chose rescue. Hundreds of billions poured into banks, insurers, and corporations. Interest rates dropped to zero. Money was printed at unprecedented levels. The bleeding slowed. Markets stabilized. Wall Street recovered fast. Main Street didn't. Millions lost jobs. Millions lost homes. Trillions in wealth disappeared. And the anger boiled over. Because the people who broke the system got bailouts. The people who trusted it got wiped out. No handcuffs, no jail time. Just bonuses, golden parachutes, and quiet retirements. The system survived. Trust did not. Because the real lesson of 2008 wasn't about housing or banks. It was about incentives. When profits are private and losses are shared, the madness doesn't end. It just resits. The next bubble always looks smart. Safe, inevitable. And if you think 2008 was the peak of financial insanity, wait until you see how a single man exploited the system decades earlier. Long before subprime loans, derivatives, or credit swaps even existed. Because the playbook didn't start in 2008, and it didn't end there either.